talk about why the Fed funds rate isn't the one actually pulling the strings. Why do they want transparency? Why do they
don't want market shocks?
Should somebody refinancing wait for lower rates?
Some of the worst advice ever, Jeb, is this: marry the house, date the rate.
More and more inventory means more and more demand.
Get yourself the numbers accurately analyzed the way you need to see them and make the best decisions for you and your family when the time comes to do that.
This is The Educated Homebuyer with Jeb Smith and Josh Lewis.
Think a Fed funds rate cut means that your mortgage rate is actually going to go down? Well, you might want to think again. In today's episode, we're going to talk about why the Fed funds rate isn't the one actually pulling the strings. And we're going to talk about what you need to focus on as a potential home buyer, somebody looking to refinance, when talking about rates, talking about the Fed funds rate, all of that good stuff, Josh. So let's dive into it. There's a lot of craziness, a lot of misconceptions on the two. So let's kind of break it down.
Well, Jeb, the best thing or the biggest thing that the last 2 years have taught us is that no one can see the future. No one has a crystal ball. We've been getting curveballs, missteps, and misdirection. You know, if you remember the fourth quarter of last year, we saw a very big improvement in treasuries. And that was led by the belief that the Fed was going to cut 8 to 10 times this year. And here we are on the doorstep
I think you
of September.
exaggerated. I think it was 6 times.
Oh, brother, go back and look. It depends on who you were talking to. People were getting real aggressive in what they were expecting. So it was a minimum of 6, and we saw the market go a long ways towards pricing that in. And that's some of what we're going to talk about today. Is there's psychology and market expectations and market memory. Mm-hmm. So the market got ahead of itself, saying, "Hey, Fed's going to cut. Treasuries should come down across the curve, especially 10-year treasuries," and it didn't play out that way. So what we want to talk about today is this belief that we at this point almost know for a fact, barring some really outlandish data over the next 30 days, when the Fed meets next month, they are going to cut. Mm-hmm. The question right now is a quarter or a half. So what I had a great conversation with the borrower that we're opening a refinance for right now. And he says, "Hey, I'm fine. I want to get going right now. I just want to know that we don't have to lock because the Fed's going to cut in September. So that means that my mortgage rate will be lower." So that's really what we're talking about today.
Wrong, Josh. So actually, and not to point a finger, but that's the misconception, is that what the Fed does directly translates into mortgage rates on that day that happens. And so I want to kind of back up a minute here and talk about what the Fed funds rate is specifically to start with, and how that correlates to a mortgage rate to begin with, because I think that will help the listener, the viewer, understand a little bit. And then we can talk about how that, the two actually move in lockstep to some degree.
Absolutely. So the Fed funds rate is the shortest term rate there is. It's the overnight lending rate that banks lend excess reserve funds to each other at. So the Fed can control that. And what does it actually translate over to in terms of consumers? There are some direct correlations in that generally Fed funds plus 3% is where the prime rate is at. Prime rate is where most home equity lines of credit are. A lot of home equity lines of credit opened over the last couple of years. Credit cards, you get a lot of that. Variable rate business loans, small business owner with a business line of credit, all tied to that. So it's talked about a lot, but in terms of your actual day-to-day personal finances, Fed funds does not have that great of an impact. Now, the same things, Jeb, that the Fed is looking at, the bond market is looking at. When we say the bond market, we're talking treasuries and we're talking mortgage-backed securities. And those are different. The treasuries generally lead. The mortgage-backed securities can't get very far away from that. But when we look at it, what does it mean? We just said that Fed funds is the shortest of short-term rates. Well, you can get, 90-day treasuries. You can get 2-year treasuries all the way out to 30 years. That's the longest treasury security that you can purchase. So the thing that will be most impacted by a Fed funds cut is the shortest end of the curve. So that stuff 2 years and below is going to move fairly closely with Fed funds. So Jeb, we've talked the last couple of years about a predictor of recession being a yield curve inversion, meaning that all those short-term interest rates are higher than the long-term rate. we should see the yield curve uninvert if the Fed follows through on what the market is expecting here, with right now 100 basis points of cuts between now and the end of the year.
Yeah, so it's not going to happen immediately, but let's. So we're comparing the two. Let's keep kind of on track here. So we've talked about what the Fed funds rate is. Now let's talk about what mortgage rates is. What mortgage rates is? What determines mortgage rates is a better way to say it.
Okay. So in terms of, let's look at the easiest measure. This isn't the explanation. This is just a measure of it. But when we look, we talk about the spreads between 10-year treasuries and 30-year mortgages. And that's measured most times when that's quoted to you. It's today's 10-year treasury versus this week's yield on the Freddie Mac primary mortgage market survey on the 30-year fixed rate. It's an imperfect measure, but it's good. It's not perfect, but it is good. So over time, that has shown, over time, say the last 25 years, it's averaged between 1.6 and 2%. It's been as low as like 1.15% and as high as 3%. So meaning right now we sit just a little over 2.5%, and we have a 10-year treasury at roughly 3.8. So 3.8 plus that 2.5 tells us that 30-year fixed mortgages are about 6.3%. So those things can change over time, both of those. So let's talk about that changing. Why do we quote the 10-year? Because over time, or I shouldn't say why do we quote it, why do we use the 10-year as a measure relative to mortgages? It's because of all of the different duration of treasuries. That is what most closely mimics 30-year mortgages in terms of their duration on the books. But what we've seen recently in terms of pricing in the markets, mortgages have more closely followed 5 and 7-year treasuries. Now, if we're in a normal market, a non-uninverted yield curve, that would mean rates are lower. But right now, the 5 and the 7 yields are higher than the 10-year. So we're looking at the 10-year and we have this spread. Well, the spread's partly high because the underlying market movement is getting priced more like a 5 to 7 year treasury. And you say, why?
And explain why. Yeah. Explain why.
Why? Why does that change? Well, right now with rates historically not super high, but very high relative to where we've seen them for the last 20 years, anyone buying a mortgage bond, a mortgage-backed security, is concerned about duration risk. If I buy a 7-year treasury, I always have the option to hold that to maturity. So if I buy a 7-year treasury and I got it when it was at 5.2%, I can get a 5.2% yield for 7 years. Well, if I bought a mortgage when rates were at 8% and Jeb is the mortgage holder and I own that bond, I don't get to get 8% for the life of that loan. At some point, and we're going to talk about this, Jeb's going to go, 8% sucks. I want 7, I want 6, I want 5, and he's going to refinance. So this bond that I owned, or I thought I owned for 10 years, for 30 years, gets prepaid. So you have prepayment or duration risk on mortgages that you don't have on treasuries. So you have the actual true government guarantee on treasuries, which says it's the safest investment in the world. So it's going to have a lower rate. You don't have that duration risk. So it's going to have a lower rate. On top of that, the rates, Jeb, that you see on the street, a portion of that is the servicing value. And you go, what in the world is the servicing value? You make your payment on your mortgage to a servicer every month. Generally not the person that owns the mortgage, but they collect your payment, they pay your property taxes, they deal with any issues when you call in, and they get paid for that. Well, that also has a duration value. If they think that thing's going to be on the book for 7 or 8 years, they can value those servicing rights fairly high, knowing they're going to make a profit. If they're worried that that loan's going to be on the books for 2 years or 3 years, those servicing rights are very small. So right now, with rates high and coming down, there's still that risk that loans even going on the books. So if we say rates peaked at 8% and rates today are closing in on 6%, there's far less risk of that person refinancing. But if we have a terminal rate in mortgages somewhere at 4.5%, 5%, a $500,000 loan at 6% is also going to prepay. So we're going to have those spreads elevated as long as there's a belief and uncertainty about how much lower rates are going to go. So Fed funds moves the short end of the curve. Treasuries are going to look at similar things, but over a longer time horizon, and those rates will come down, but at a slower rate. And then those spreads should normalize. And none of those things, Jeb, we all know the direction right now is down for all three of those items, but we don't know where they end. We know historically, if we go back and look at the last 25 years, where they might or should or could end, but we don't know that history will repeat itself and we will actually get back down there.
Yeah. So what I hear you say when you say that is when there's less volatility in the market, there's more stabilization. There's a clear, if there's ever a clear indicator of the direction that we're going, the closer, the more narrow those spreads are going to be, which in turn, depending on where we are, is going to translate into a lower mortgage rate when compared, when you're factoring in that the Fed funds rate plus whatever the spread is. So, but let's talk about the disconnect, Josh, the disconnect between the Fed funds rate and mortgage rates. Because again, we started by saying, if you think that the Fed cutting 25 basis points, 50 basis points directly translates into 25 or 50 basis points lower on your mortgage rate, you're probably wrong. And let's talk about why that's the case.
Well, Jeb, let's look at what already happened over the last 2 months. We went from a 10-year treasury over 4.2 in that 4.2 to 4.3 range, depending on what day you want to look at. And today we're at about 3.8. So we're 40 to 45 basis points better on 10-year treasury yields, and the Fed hasn't done anything. Why is that? Because the market believes that the data that the Fed is looking at is going to lead them to cut. And that also means that investors require less of a yield on 10-year treasuries, on 7-year treasuries, on 30-year treasuries. So the market, actual buyers of treasury bonds and mortgage-backed securities, they're moving ahead of what the Fed does. And if we go back and look to 2022 when they first started hiking, it's the same thing. The market panicked and we saw the treasury yields rise well ahead of the Fed taking action. So the Fed is very deliberate. We've seen this. They were very deliberate on the way up. They should have been hiking before they did. And they're very deliberate on the way down. And you just mentioned an important word, transparency. They want to telegraph what they're going to do. They want to let the market know.
And why, Josh? Why do they want transparency? Why do they want, in theory, less volatility in the market? Why don't they just want to come out and surprise the market?
They don't want market shocks. They don't want, let's flash back to COVID. What was it? Was it March or April when they basically had a 100 basis point cut overnight on an emergency meeting on Sunday? Okay. It's not a business day. They're not expected to meet that week. They're certainly not expected to do a meeting on a non-business day. And they said, this is so important, so urgent, so critical that we have to jump in and make an unprecedented cut on a non-business day and shock the world. Shock in a positive way, stepping in and saying, we got this. Well, what if they came in next Sunday and announced a 100 basis point cut? The market would go, what's going on? What does the Fed know? What's wrong that we're not aware of? They don't want to send shocks through the market. They want to telegraph at the meetings. They have, if we go back to the 80s and even the early 90s, they didn't have a press conference after the meeting. They used to not put out a statement. There was an announcement that, hey, rates are remaining the same. Rates are up a quarter. Rates are down a quarter. No announcement explaining what they were doing and no press conference. They want transparency. They want to telegraph to the market, here's what we're watching, here's what we're seeing, here's how we're interpreting it, and here's how we are likely to act going forward in a slow and deliberate manner unless the market forces our hand to do something differently.
Got it. So a moment ago, you said we've already improved about 40 basis points or so on the 10-year when the Fed hasn't even cut. So is it fair to say that the market has already priced in what they believe to happen come September Fed meeting, right? So at the moment, I haven't looked at the numbers, so I'm quoting what I saw last time. It's about 65 or so percent that the market was expecting a 25 basis points cut. And so the other 35% was expecting 50 basis points. So 100% is priced into the market by real traders putting money on the line. It's not me and Josh making bets over here with each other. This is real money out there. So with that, 25 basis points is probably built in. Is there an opportunity that 50 basis points provides a little bit more, relief when it comes to mortgage rates? Or do we think that is potentially priced in as well?
I don't think 50 is priced in. You could say that it is, because if we're down 42, 43 basis points on the 10-year yield since the market came around to the idea that September is the date and the Fed might be cutting 50 basis points, we could say that it possibly is. But a lot of it comes to direction and what the Fed signals. We just talked about them being transparent and wanting to let you know what they're saying and thinking and feeling. They're going to have an announcement, and then they're going to have a press conference after that. So let's say they cut 25 and they come back and say, hey, we were debating between 25 and 50, definitely looks appropriate for more cuts in the future. Well, then they'll start pricing in those next future cuts. Some or all of 25 basis points is already priced in. Possibly some and even the majority of 50 basis points may already be priced in. A guest that we had on the show previously, Jeb Barry Habib at MBS Highway, they're doing their analysis, and this isn't far off from other bond market analysts saying that there is a path between now and the end of the year to about 3.25. So if we're at 3.8 down to 3.25, it's a little bit more than another half basis point or 50 basis point improvement. Now let's look at that. So if we think at the next meeting, 25 to 50 basis points, and the futures market is pricing in 100 between now and the end of the year, well, now we're looking at there should be another 50 there. And that would generally, if 10 years follow in a similar pattern, would be that 3.25. And the treasuries will probably get there before the Fed because they're forward looking. They're listening to that guidance and what the Fed is saying.
So with that, Josh, somebody's out there looking. I'm setting this up as a question so that we can address it. But somebody's out there looking, like the gentleman that you mentioned at the beginning of the show. And he thinks that, rates are going to come down in the future, whether it's the Fed lowering the Fed funds rate and that translates into a lower rate, or, the economy softening, unemployment going higher, inflation continuing to come down. Those metrics leading to a softer economy leads, the idea that, the Fed's going to have to do something to stimulate the economy and rates are going to come down with that. Should somebody refinancing wait for lower rates? So should somebody buying now that's, finding what they are looking for in the market, right? It's the right time in their life. They have all the other indicators other than what the rate is. Should they be waiting for lower rates? Because we know they're coming. So what's the risk of waiting versus doing something now, I guess, is the better question.
Let's address refinance and purchase separately because I think it's a different decision depending on each of those. And let's also step back because this is going to be the guiding light in this decision. You just said because rates are definitely going lower. Well, you and I thought that in the fourth quarter of last year, and we ended up being very wrong. We almost got all the way back up to 8% after, approaching 6% over the holiday season. So all signs point to lower interest rates, but we have no guarantees. So the guy that I'm talking to on that refinance, smart guy. Like I told you, like he's telling me like 4 or 5 guidelines in his loan file. I'm like, my man has done his research. He knew all of the guidelines. He knows what he's watching on CNBC each day and where the market is likely to go. He is correct that rates are likely to go lower. I have no problem with someone saying in that situation, hey, let's get going. Let's get my loan approved. I want to float it and see what happens over the next 2, 3, 4 weeks, possibly past that next Fed meeting. Now, let's look at 2 different sets of borrowers. I have one that perfect A-paper, top-of-the-line borrower. They bought last year at 7.375. It wasn't the worst rates, but relative to where we are today, not good. They're looking somewhere at about a 6.125, 6.25 rate today. So do we, on a $700,000 loan, forego a guaranteed $400 to $500 a month savings starting 2 weeks from today because we believe rates are going to go lower when we've been head faked before? Probably not. In that instance, what I'm going to recommend is don't pay points to get that rate down, possibly do it no cost where we're able to cover your closing costs for you so you have no sunk costs in there. And let's watch what happens over the next year. And hopefully we're at 5.5, we're at 5.25, we're at 5%, and we're able to redo it again. But ring the cash register in that situation. I have another client that it's an FHA loan. They're at 6.25. To be streamline eligible, you have to get a 0.5% lower. We can achieve that right now. We can get it about 6.625. So we get a little bit more than a 0.5% savings. This is a smaller loan, about $450,000.
You mean 5.625, not 6.625.
5.625.
Yeah.
Smaller loan, about $400,000, $450,000. So the dollar monthly savings are less. And on a streamline, they have an interesting quirk that you get a refund in the first 36 months of a small portion of your upfront mortgage insurance premium. And then they tack a new one on that loan. And when we look at that, there's no way short of bringing in a chunk of cash to close that you can't walk out with a higher loan amount. So we say, okay, we're lowering your monthly payment $190 a month. That's real money. That affects your bottom line. That affects your budget. But we're also walking out with a $4,800 higher loan balance. Now, if we believe to 70, 80, 90% certainty that 4 or 5 months from now, we're going to get you 5.5, 5.25 on that FHA loan, that borrower, very reasonable decision to wait. So this is where we talk, Jeb, that it is important that you are working with an advisor, a mortgage advisor who can go through these numbers and help you quantify it. There's no right or wrong decision. I've had borrowers in that same situation say, dude, I need the $190 a month savings. We got to do this now. Okay, valid decision. I've had other people go, I don't want to go the wrong direction and increase my loan amount. So let's push it off and see where it goes. Also a valid decision. So you just have to look at it. For those people that are in a position to drop their rate close to 1%, my belief, and again, I don't get to make the decision, the borrower makes the decision. We quantify it, we put it on paper, we show them the numbers, and they make the decision. But if you can save 1% on your interest rate and you got a $400,000, $500,000, $600,000, $700,000 loan, those are substantial monthly savings. We probably should lock those in. So now, Jeff, before we talk about what do home buyers need to be thinking in terms of now or wait, let's talk about your decision. You are going on your second refinance on a loan on a property that you just purchased in the last year. What was your decision on when to move and what to do with that?
Yeah. So about 3 Mondays ago, when we saw the 10-year drop, right? We saw the 10-year, but within about a week, we saw the 10-year move considerably because of unemployment going higher. And I forget, something else came out and it affected basically the data. And so Monday morning kind of woke up and the 10-year was at 3.7 something. So I called and said, hey, listen, is there an opportunity? Like, what are rates today? And rates were at 6%. So I started at 7 back in November. I refinanced to 6.5 about a month later. And now I'm at 6% still within the year, right? So why did I do it now versus somebody on camera telling you that rates are probably going to continue to go lower as the market normalizes a little bit? For exactly what you said, I'm taking in the gains, right? I'm taking in what I know I have now. Fortunately, I'm able to do it at no cost outside of, like, I have prepaids, I have property taxes and impounds and stuff that I have to bring in money for. But I'm not paying actual closing costs on the loan because there was enough credit back to me based on the interest rate that I took to cover those costs. So it was a no-brainer for me to take advantage. I'm also in a unique position where I'm self-employed. And so how I file my taxes can impact whether or not I'm eligible to refinance because, DTIs and certain things. And so because the market changed a little bit in 2023, my income is affected by that. And so filing my taxes, I push my extension out until October to file it, just so that I know I'm not going to be affected by that tax filing. So I may still be eligible. I haven't run the numbers, but I just wanted to make sure I lock in the gains now that I have available when they're out there. And so, Josh, you said something really important a moment ago in the example of the FHA buyer, where they would save about $190 right now, but it would add about $4,800 or $4,400 or whatever the number was. That's a 2-year recoupment period based on their savings. So they need to have that loan at least 2 years in order to recoup that additional that they added back on there. And because rates are going lower, you made a very valid point. Like, that's what a professional should do is, hey, this could save you money now, and we could cover your costs, but it's creeping up the balance and kind of eliminating paying down your mortgage, which is the goal for most people, to pay off that mortgage. So, and the reason I bring that up is because if you're somebody out there, that's what your mortgage professional should be doing. They should be giving you examples. They shouldn't be just saying, hey, because you can go from a 7 to a 6, you should do it. Because you're going to save $200 a month, you should do it. That's not how it works, guys. You should have somebody telling you, hey, this is your example. This is, transparency laid out there. So when I say that, I'm being honest and real. And if your guy's not doing that, your girl's not doing that, reach out. Let us be, another guiding light, if you will. Let us serve. Let us look at your loan estimate, tell you what we think about it. I say Josh, not me, the team here, and guide you through that process. And if you're just starting the process, again, regardless of where you are in the United States, reach out to us. We would love the opportunity to serve you and make sure you're getting taken care of. There is a link in the description of the video that will actually get you there. So
let me piggyback off that, Jeb, because you said something really important. You're in the business. You make YouTube videos. You do a podcast about housing, mortgage, interest rates. So when you walked in Monday morning, your inbox is lit up with stuff and you made a proactive phone call. Most people Monday morning, they head to the office and they're selling widgets. They are manufacturing something. They are in meetings. They don't have the opportunity to do that.
Correct.
So we have a lot of people right now, a fairly large list of folks who it doesn't make sense today. They've made that decision. Yeah, there's some savings there, but I do want to see what happens going forward. So in addition, a good advisor can put you on a list and we have a target that says, hey, if and when we hit this point, we're ready to go. So you get a phone call that Monday morning that, hey, we're seeing this weird yen carry trade unwind and bond yields dropped 30 basis points since Friday. Doesn't quite make sense, but we have an opportunity here to lock it in. Do you want to do it? We've already thought through the hard part. We've taken the emotion out of it and you can go, boom, push the button. Let's get it locked. Let's roll. So having an advisor that can quantify your benefit and whether it makes sense to do it now or wait. And if it's wait, okay, at what point do we pull the trigger, and being on that watch list so you're getting a phone call when the time comes. So don't feel like if you reach out and you use that link in the description that you go to theeducatedhomebuyer.com/expert and you reach out to us. That doesn't mean that we're selling you a mortgage. It means we're going through the same process that we do with the buyer of saying, does it make sense? Do the numbers work for you? Yeah. Does this make sense? Does it fit within your larger financial plan? Even if you haven't thought it through, because that's my job, is to ask you questions, poke prod, put things on the line so you can go, I hadn't looked at it in that lens, but now that you ask that way, here's the decision for me and my family. So
I hear Josh tell more people it doesn't make sense to do something than it does make sense to do something. So know that going in, right? It's the numbers don't lie. Somebody that's, this is our career. So we're here to guide you. With that, Josh, again, the last thing I'll say about that, I made that proactive call on Monday. Within about an hour, maybe 30 minutes after me making that call, that loan getting locked, things went sideways and rates went up from there. And had I waited an hour, a 30-minute, whatever, that opportunity would have been gone. And quite frankly, it's not even, I don't know that it's back yet. And that was 3 weeks ago and the loan's getting ready to close. So be proactive, talk to somebody now, tell them what you're trying to do, let them put you on a list, let them stay in touch, and you'll be good to go. What do we want to go from here? I mean, I think that's a clear.
Jeb, that we talked about refinancing. Now, what about the question for buyers?
Yep.
Yeah, let's talk about the purchase side. Let's say someone calls you, hey, Jeb, I want to buy a house, but I think rates are going lower. I know what your answer is going to be. Your answer is to say, hey, you still need to get pre-approved today. Mm-hmm. So we can say, what do you qualify for today? What do you qualify for if rates drop 0.5%? But here is the important thing to note. The things that would be happening in the economy for rates to drop precipitously means that it's not as strong or solid an economy. So there's an element of that. But we are still faced with the fact that the majority of adult age homeowners or household want to own a home. There are many people that have been on the sidelines. So do I think that demand skyrockets and shoots through the roof if rates go to 5.5? I don't, but I do think it increases significantly. There will be some additional supply coming back into the market for people who had twins last year. And they're like, oh, I can't give up my 3% rate for an 8% rate, but I can for a 5.5 because I got two twins that are now 2 years old going nuts every day and I have to do it. There'll be some additional supply. There will absolutely be additional demand and prices are likely to go higher. We've talked about a million times on the show, Jeb. I don't get hung up on home prices. I don't get hung up on interest rates. I do get hung up on what percentage of household income goes to purchasing that home. And we're at very high levels now because both of those things moved against us. Prices went high, interest rates went high. Prices are likely to remain near where they are now or to go slightly higher, but interest rates are moderating. So people will look at that and go, I couldn't allocate the percentage of my household budget or household income to housing that it required to buy a home last year. But some of those people will be able to do it this year. Mm-hmm. So some of the worst advice ever, Jeb, is this: marry the house, date the rate. Mm-hmm. But there's a truth underlying there in that the house is forever because you're going to be there a long time. Transaction costs getting in and out are fairly expensive, but you do have an option to get a lower payment. So if rates go lower in the future, you're likely to pay more for the home. But if you lock in the price of the home that you can afford, that is not stretching your budget, that you can do it now, if you're right and rates go lower, we have the option to lower that interest rate in the future and realize that savings without having to pay more for the home because there's a little bit of increased demand with greater affordability.
And the thing I'll add to that is if you're in one of these markets where you're seeing a big increase in supply, it's back at 2019 levels, you're seeing more and more homes come to the market, you've probably got a better opportunity to wait. Less of that concern about, prices continuing to rise and more so price stability and even potentially prices coming down to some degree, depending on where you're located. Us in Southern California, most of the United States, one of the recent infographics that came out from Resi Club showed the number of sellers versus the number of buyers in basically the greater majority of the United States. It did a lot of different markets, but it did a national one as well. And nationally, there's still more buyers than there are sellers. So for most markets, it's still a seller's market. And so waiting typically means higher pricing just because of that lack of opportunity out there. And something I want to make a point of is while you're waiting on more and more inventory to come to the market, more and more inventory means more and more demand. And you're like, what do you mean, Jeb? Because those people have to buy homes. People don't sell their homes and just decide that I'm just going to live on the street. I'm going to go live with mom and dad again. No, they are also buyers. So more sellers means more buyers. Lower rates mean more buyers. This isn't a push to say go buy a home today, but it's a push to be clear with what you're trying to accomplish, come up with a plan, and execute on that plan, whether it's a year from now, 2 years from now, 6 months, whatever it is, just come up with one and figure out and how to get there. So with that, Josh, one thing we didn't ask today earlier in the episode is if you find any value in episodes like this in our content at all, do us a favor, hit that thumbs up. We want to help you. We want to guide you through the process. We want to educate you. And if you find any value in those statements at all, you subscribe to the channel. We continue to put out content like this because we are here to educate. So Josh, I'm going to throw it your way to lead us out.
Well, for the first time in a couple of years, the trend is our friend, at least in terms of interest rates and affordability. Doesn't mean we're going to get record levels of affordability. It doesn't mean you're going to run out and look at the payments required to buy a home and go, this is fantastic. But you're going to say it's fantastic relative to where it was 6 months, 12 months, 24 months ago. So the sort of thesis today is, hey, Fed funds is going to get cut. Several times at the 3 meetings, the remainder of the year. Maybe I should wait. We saw last year, there's no guarantees. Talk to expert advisors, go through your numbers, get yourself the numbers accurately analyzed the way you need to see them, and make the best decisions for you and your family when the time comes to do that.
And that's all that matters, guys. Worrying about you, not worrying about anyone else. Focus on your own plan. Have that longer term time horizon. Have money in the bank. Be comfortable with your monthly payment. And more importantly, buy right, borrow smart, build wealth. Until next time, adios.
Amigos.